Good morning, everyone. Thank you for joining us today. We wanted to do a webinar on how we can beat volatility with multi-asset investing. I think this has come at a appropriate point in time, primarily because May has been a pretty volatile month, and there's been a lot of speculation about how the markets are going to be, what the outcome of the election is going to look like, whether that's going to affect market sentiment or not. And you have this very divergent trend between how FIIs and DIIs are looking at the market. So we thought it would be a good time to look at what market volatility is like, how that affects the way investors behave, what that means for an investor, and how they can protect themselves from volatility because you can't really prevent it, right? It's completely out of your control because so many factors are going into making the markets volatile. So to start off with, let's actually look at this famous sort of saying about sell in May and go away. So if we look at how market volatility has been in the last 1 month, when you looked at how April was, right? So from January to April, there's been a more or less steady decline in volatility where you reached a bottom or a trough towards the end of April, right? So your VIX, which is the India Volatility Index, was at about 10 um, in April. And that was the bottom. But within a week, you had volatility really just spike up and you went from 10 to 20 within, say, maybe 10 trading sessions or so. And this has largely been, if we look at what is causing this volatility, there's been a very divergent view between FIIs who have been looking to profit book in India, who have been a little bit more uncertain about what the political scenario is going to be like, what the policy scenario is going to be like, as well as fundamentally whether India is a good market. So there's been globally, there's been a risk off sentiment. So in this month, if you have been paying attention to other asset classes, you would have noticed that gold and silver also started picking up in terms of performance, right? So there's been this move away from risk on to risk off. And again, if we study the FII trends, you'll notice that while FIIs are pulling out of equity markets, they're actually putting money into fixed income markets. So this is an important trend. And I think one thing we need to recognize is that we can't really control volatility in the sense that we can't prevent it from happening, but we can control our response to that. And one great solution to controlling your response to market volatility is to actually have a multi-asset strategy, right? Because then at any given market context, at least one of your cylinders is really going to be firing for you. So if we look at how investors behave in volatile markets, you will see that these are some common ways in which they respond to volatility. So you have people who think that, okay, the market has already moved up, so things are expensive. Maybe I should just stay out for a bit. And then when the market corrects, I'll come back in, right? Then on the other hand, you have people who are very confident that, I have enough proof now, so let me put some money in before, it completely runs away. And then you have the flip side, right? So if you rush into something at the wrong time, then you start questioning whether you made the right decision. And you think that maybe, I should have been a little bit more patient. If I had waited just a little bit, my portfolio wouldn't be down today. And then you have those who've been sitting on the sidelines waiting for the right moment to come before they start investing, who then will turn around and wonder, have I really missed the bus? Did I wait too long? Should I have done something before? And when you have this kind of context, what is the consequence that the investor faces? So if you look at the result of this behavior, the person who is trying to time the market and waiting and saying that, okay, this has happened, that has happened, they don't have any investment discipline. And that is an expensive price to pay. Then those who wait for proof and then participate generally tend to chase performance, right? And when you chase performance, your returns are actually going to be lower because you missed the first early extra return that you could have made by being a little patient. And now the person who's going to be checking their portfolio regularly to see whether they're net in profit or loss is generally not going to enjoy investing, right? And it's something that all of us have to do, and we have to do it for long periods of our time here. So I think it doesn't make sense to be so anxious and to be so worried about your portfolio. It should be something that you're enjoying, something that you're able to participate in without too much fear or worry. And if you wait it out, right, or if you're trying to optimize too much, then what you actually miss is quite a big thing. You miss hitting your milestones when you should be hitting them. You miss creating wealth at the speed or the pace that you should be creating wealth simply because you're waiting for something better to happen for you. Uh, the key takeaway here is that there is actually no good time to invest in the market, right? You have to do it according to what your life demands of you. You have to do it according to how much you're able to save. If you keep waiting for the right environment, for the right moment, it may never come. And there's a lot of work to be done right now. We may not be able to see 5 years into the future. We may not be able to see that far ahead, but we are able to anticipate what we need to do today. And I think that's a great place to really begin. So what you want is a philosophy, right? And if I look at a really good philosophy, you have Ray Dalio, who's this amazing hedge fund manager for Bridgewater Associates, and you see that his idea of what investors need is a good strategic allocation, right? Meaning you should have assets across, I mean, you should have investments across asset classes, and you need a balanced and structured portfolio which does well in different environments. You don't want to have a portfolio that performs only under certain assumptions, right? Because many of the times your assumptions can change, and you can't change your portfolio as often as you can change your assumptions, right? Because there are real world consequences to constantly changing your portfolio mix. Primarily, you will trigger tax, you might have to book losses. It will reduce the quality of your investing. It will definitely reduce the quality of your emotional makeup, because if you have to constantly adapt to what is happening, you are going to create a certain level of anxiety and worry about whether you're doing the right thing or you're not doing the right thing. So the way to do this is to actually have diversified bets. And broadly, this is how we're going to structure our conversation. We're going to look at having a good strategic asset allocation. We're going to look at how to have a portfolio that does well in different environments. And we're going to talk about what diversified bets are. Now, essentially, how we'd like to do this conversation is that we would have Q&A at the end. We'd be happy to take in whatever you want to discuss, and we will see, uh, you know, how we can take this forward. So moving on to part one, which is our strategic allocation, right? So let's kind of just spend a couple of moments reflecting on what we know about our journey as investors. So what do you think is the best investment? And do you think there's something that can be a bad investment per se? And do you think that performance actually follows some kind of pattern? Meaning, is there a way for us to predict returns if we can identify these patterns and see when they are replicating? So this is something that maybe beyond the webinar, you can spend some time thinking about. And when we try to answer these questions, you will find some solutions to how you need to structure your retirement or your investment portfolio, right? So we answered some of these questions by looking at the asset allocation quilt, right? One thing we noticed was that no, we can't really predict returns. There isn't a fixed pattern. There are some trends, but there isn't a fixed pattern. And sometimes we're misproved about what our patterns could be, right? Um, so what we learned was, and I'll get to that, but what we learned was about, okay, what can we do with this information that we have where you see trends in terms of data? So I'm going to quickly do a poll here, and you can type in either A, B, or C, which is, can gold give 0% returns, right? Do you think this happens on a regular basis? Do you think it doesn't happen at all? Or do you think that, okay, maybe sometimes it happens? Okay, so we have two answers for gold giving no returns. We have a couple of answers for rarely gives no returns. And then we have again a few answers for. Okay, so this is a good mix here that we're seeing, right? We do have some level of division in terms of how people view gold as a saving. So traditionally, I think for us, gold has always been the safest investment to make, primarily because there is a perception that you can't really lose money because gold is always at least worth what gold is, right? Uh, so let's actually look at the data, and we picked up this from ICICI multi-asset presentation, and they show us that actually gold prices in terms of rupees is goes through phases where you don't make returns. For those of you who answered B, that no, gold can't lose value, I think there is an intuitive understanding to what you are saying, right? If I have 10 grams of gold, I'm always going to have 10 grams of gold. It's only the rupee value of that gold that is changing. But 10 grams remains 10 grams, right? And that's a valuable asset to have. Um, but because we live in this world where there is money and it's not backed by gold, from time to time, your money to gold value can change. And that's why you have these phases of zero returns. And if we look at this, so if you look at this period roughly between 1999 and 2006, you didn't really see gold prices move too much. It was around 5,000 to 6,000 rupees. It was trading in that range, right? Then you had this really good phase of performance between, say, mid 2005 till about end 2012. This was a phase where gold compounded at 25% over this period of time. And that's a time frame of six and a half years, right? So in this phase, you had stellar performance. So whenever gold goes through these phases of no performance, it's usually followed by a cycle of good performance. Then you had the next phase of consolidation or your 0% return phase between end 2012 till about 2018, right? So you had few years where there was pretty much no return from gold. And then you had again in the last 5 years, you've had really good performance of nearly 15%, right? And even if we weren't paying attention to gold prices in the last 5 years, I think everybody has been paying attention to gold this year. Because if you open up the newspapers any day that you're picking it up, either they'll be talking about gold prices or they'll be talking about silver prices. And this challenges like some of our assumptions, right? In terms of gold performance, because 2020 you would have expected, oh, was a recession year. You didn't really see much performance in 2020. You actually saw that performance in 2021, right? So I think this is an interesting space for us to really look at how assets work, because it doesn't work in the theoretical frameworks that we think they do. Instead, what works is understanding that different assets perform at different times, and probably that's a good way for us to also structure our portfolios. So with this, I'll come to the three takeaways we had. Oh, sorry. So I think here what it is that there is no such thing as a good idea or a bad idea. We think that basically something is a good idea at a price or it's a bad idea at a price, which means that you need to understand that objectively you can't say gold is a good investment or gold is a bad investment. If you were in a 0% consolidation phase, it was not a great investment to make, right? But if you're in that phase where gold is actually gaining traction and gaining value, it's a good investment to make. So what really matters is the price. So with that, our three lessons about all assets is that one, there is no year in which you make only negative returns, right? That is across all asset classes. You've never really had that, regardless of how big the financial crisis has been, right? If you look at the 2008 crisis or if you look at COVID, there's always been some asset class that actually performs in the worst conditions. Then the second thing is that heads you win, which is around half of the time, more than all, I mean, all your assets are going to deliver positive returns, which essentially means that, okay, there will be some years where some assets are giving you negative returns, but half the time your whole portfolio is going to give you positive returns. And the last is that we need to cultivate resilience in our investment portfolios, right? That is the only way you can have a well balanced and structured portfolio, and you can have a portfolio that does well in different environments. And that means that you need to recognize that losers can become winners and winners can become losers. And that's exactly what we saw in the gold slide, right? So you have years where gold is not performing, you have years where gold is performing. So your loser becomes a winner. And after a good period of performance, again, you go into this 0% of consolidation phase of no returns. Now, I think the most important thing is that we recognize this and we learn to implement this. And while we've talked about gold as an asset class and looked at phases of performance and underperformance and no performance, I think we need to recognize that this happens for all asset classes. It's not just about gold. It happens in fixed income. It happens in equities. It happens in commodities. It can happen in any investment that you make, right? Because all assets tend to give you cyclical returns. So now we'll move on to the second uh, sort of segment where we're looking at how do we do well in different environments, right? So the most important thing is to recognize that each of your assets actually bring different strengths to the table. So if we look at domestic equities, you're really looking at wealth creation today. If you're looking at foreign equities, you're looking at geographic diversification. And that means that, let's say India is going through a low growth phase and you want to still participate in equity as an asset class, which is going to give you some growth benefits or some boost to your returns, then you can look at equities of different countries or geographies, right? So that's the second thing. Then you have short-term debt, which basically brings you portfolio stability. If you're somebody who has a goal coming up, you don't want your entire portfolio to be in a situation where you don't know what it's going to be like 1 month from now or 3 months from now, right? You want some level of clarity that you can fund your goal with ease. So you need that stability from a short-term debt investment. When it comes to long-term debt, you're basically looking at making a slightly higher return because you're taking a slightly higher level of risk in terms of volatility. So this is like, in a technical term, we would call it yield enhancement. Then you have precious metals, which are basically stores of value. So back to our poll and tying back to what we were talking about, when you own 10 grams of gold, you own 10 grams of gold, right? That value is stored in the amount that you own. The price can fluctuate, but essentially it protects you against too much money printing. It protects you against too much inflation, which is basically one of the things that the world is seeing in the last few years. And then you have commodities which basically go through cycles. And I think most people understand the commodity cycle because there is a lag between production and capacity creation. And so that tends to actually give you lumpy returns at different points in time. So this is what each asset actually brings to the table. And you'll notice that each of them have unique strengths, right? Uh, Equity cannot give you the kind of yield enhancement or portfolio stability that debt can give you. Similarly, debt cannot give you the store of value that precious metals can give you, right? And commodities give us returns at different points in time. So you'll have this similar to what happens with gold. You'll have a consolidation phase and then you'll have a good return phase, right? So clearly, like what each asset is bringing to the table is different. And if you want to really beat volatility with mathematics, we need to understand this concept of correlation, which is that if two assets have a high positive correlation, you will notice that their values will increase together, right? So if you have equities, typically even with domestic and foreign, there will be a slightly higher correlation than say equities and fixed income, right? So the higher your correlation is, the more likely those assets are going to move together. But the lower or the more negative your correlation is, your asset prices are actually going to move in opposite directions. So when you have slightly negative or low correlation assets in a portfolio, what tends to happen is what is driving the price of one up would basically drive the price of something else down, right? So then you might complain that, oh, I'm not really making a good return because I'm giving up on the upside. But what we're forgetting is, in times of uncertainty, in times of distress, what you want is really to protect yourself from the downside, right? And when you have exposure to the themes or ideas that are negatively correlated with the rest of your portfolio, you tend to make more returns in these phases, and you can have a much stronger outcome in terms of wealth creation. So we've taken this data from this really interesting website called Math is Fun. And those of you who enjoy mathematics should actually go and look at some of their resources, because it's quite, it's quite nice, right? So again, to think about how we can beat volatility with math, this is some data that we've taken from Bandhan Mutual Fund. And you can see here that if you look at the Nifty versus the MSCI, ACWI is basically all countries in the world, right? Their equities. You notice that and gold, you see gold has a negative correlation with equities, right? It also has a slightly negative correlation with the global index. And short-term debt is low positive correlation with pretty much all your other asset classes, right? So clearly, when we look at this correlation coefficient, you see that there is some benefit in having a little bit of everything in your portfolio. So now we'll move to our third section, which is diversified bets. And how do we really look at this piece, right? So there's a really famous author called Peter Bernstein, and he's also an investment professional. So what he says about diversification is that it's not just a survival strategy, but it's actually an aggressive strategy, because the next windfall might come from a surprising place. So this is what we were talking about, right? What we hear often when we tell people diversify a little bit, the thing is, oh, why should I move out of equity or out of this performing asset class into something that's not performing? Because am I not giving up some returns, right? And just because I want to manage risk a little better, you will hear this very often from people who think that they are aggressive investors because they want the best outcomes, right? And outcomes are being measured by only the return component. But when you do diversification, you're actually creating some optionality in the portfolio and saying that maybe this asset is going to be the biggest performing asset in my portfolio. I just don't know at this point in time. So let's be practical about how we look at portfolio construction. And to do that, I want to talk about what investors are actually really worried about today. So our team regularly talks to investors on these webinar platforms. We also talk to clients regularly. And through all of these conversations, what we've actually learned is that what crops up, right, as some level of concern is, okay, isn't inflation a little too high? Won't there be a global recession? I read in the paper that the yield curve has been inverted for so long. What are we going to do about these wars? Because daily there are updates about what is happening in Ukraine, what is happening in Gaza. So that is definitely weighing on investors. And especially now, because Indian election results are around the corner, people have been talking about the election outcome, right? But this is not, I don't think we're over with the election fever, because 2024 is actually a year where a lot of countries are going into elections, notably the US elections, which are going to happen around November. So I think, given all of this, the like this election fever, this worry is here to stay for some time. Then I think one thing that has been bothering investors a lot is about markets moving up, right? So we've never seen this kind of strength in terms of equity performance. You've never seen this sea shift in the way people are moving out of traditional avenues like fixed deposits into mutual funds or equity schemes. We've never actually experienced so much volatility so fast before the elections. So a lot of interesting uh, things that investors are paying attention to, things that are worrying them, and things that we need to solve together, right? So when we look at what's happening here, we need to see how we can turn these worries into opportunities. And again, I'm going to take the same thing in terms of what each asset class is bringing to the table and what it does today. So if we look at this, you see that domestic equities, you've had strong growth and much wider market participation. So just go back or spend a couple of minutes today doing a few Google searches. Look at the number of demat accounts that have been opened. Look at the pace at which SIPs are growing. You can go to AMFI's website and see this data. And you'll notice that, okay, more and more people are believing in this market. So there are a lot of domestic flows. And if you look at how strong the domestic flows are, previously, if FIIs took out money, right, you would see the market crash. And that has not happened in the last few years, primarily because domestic flows are able to keep pace with the foreign investment flows. So I think when you look at foreign equities, you will see that there are many high value opportunities that are there across the world, primarily because other markets. So if we look at, say, the US market, there's been a very narrow performance that you've seen. Yes, the index is going up, but very few things are actually pulling the index up. So you are unlocking many value opportunities in that market. Similarly, if you look at Japan, because of this return of inflation that's happening, newer opportunities are opening up. If you look at China, again, you've had those markets really come down. You've had a period of economic uh, slowdown, and now you're seeing early signs of revival. So there are many global opportunities that could open up for an investor who's paying attention to them, right? And if we look at short-term debt, today we are at high yields. The way that central banks are talking about policy making, you will recognize that essentially they don't think that interest rates are going to come down in a hurry, which means that you're high for longer, right? Maybe you're not going to see rates move up, but you're certainly not going to see them come down either. And as long as you're in that sweet spot, you can capitalize on this, especially if you're worried about specific equity valuations. You can wait it out and really come back when you're comfortable. Then at the same time, for the same logic in terms of where interest rates are heading, you can actually look at long-term debt, right? And that means studying mark-to-market gains or the potential for them as the cycle turns. So this is a slightly more volatile strategy. It's a slightly more um, aggressive strategy, but and probably longer term as well. Then you have precious metals where you're basically looking at all of the uncertainty in the world in terms of geopolitical risk, in terms of war, in terms of trade agreements, in terms of relationships between countries. And also, you know that when the cycle turns in terms of interest rate cuts, people are going to move money out of, say, fixed income assets into something where their value can be more accurately preserved, right? And those of you who are actually worried about inflation risks, commodities could be a great space because, as we know, commodities are a little bit more inflation resistant than, say, your equities uh, per se, right? So the key thing is whatever we're worried about, there is a solution, and the solution comes from asset allocation. All of these worries are true. There's nothing wrong about paying attention to these parameters. There's nothing wrong about thinking how that's going to affect your portfolio. In fact, it's a good thing to do. But we need to move beyond that anxiousness or that anxiety phase into the action phase where you actually diversify your assets and create an asset allocation strategy for yourself, right? And this is where the magic happens for us. We have a product called Sphere, which is a portfolio management service registered with SEBI. And let me show you what we've done. So we have a way to make asset allocation work for you. We do this by being conscious of valuations, which basically means we're very careful about the price we pay for certain things. So coming back to Howard Marks's quote, where you said there's no such thing as a good or a bad investment. It's a good investment at a price. It's a bad investment at a price. We try to make things good investments by being specific about the price that we're paying, right? Then we try to stay away from the crowd because our style is contrarian in nature. We don't chase performance, which is something that we notice actually when you chase performance, you tend to reduce the kind of returns that you can make. We believe in being a little bit more patient because, as the saying goes, good things come to those who wait. And we're very clear, right? A little bit of everything works. So why not just stick to that? So if we look at why multi-asset investing works, we've recognized that it suits a much wider range of risk profiles because you will have somebody who's a conservative investor who needs to have slightly more aggressive calls in their portfolios because their targets are such that they need to be a little bit more aggressive. You also notice that the moderate investor who's expecting a certain return range, you can beat that with multi-asset investing. And the most important thing is that we wanted to create a saving product, right? We wanted to create a product where investors treat this as a saving vehicle. So if you're saving up for retirement, you want to be able to save month on month. You don't want to think about today, is the market up? Is the market down? Should I make an investment? Should I wait? We wanted to create something where you can easily save continuously. And that is the core of what Sphere is. And in terms of performance, I have end of April data where you can see that we've compared Sphere with dynamic asset allocation funds as well as flexi cap funds because we are a slightly skewed towards equity portfolio. So when you look at this, you can see that we've been consistently sort of good with performance, and that's the way we'd like to take it forward. Of course, our track record is not that long, and you can wait for us to show that we can consistently work in terms of meeting return expectations. We aim to be in the 12 to 15 range, and cyclically we can do more than that, but we're not aiming to take more risk in the portfolio. So when we look at drawdowns, which is basically a measure of underperformance or negative performance, you will see that we're somewhere between the multi-asset index that we're benchmarked against and the Nifty, closer to the multi-asset index, primarily because we want to manage that risk for an investor really well. And this is our performance data from April. So you can again see that our 2-year performance has been pretty good. Again, to illustrate, there is at the overall scheme level, we're about 80% in equity. That again reflects our philosophy of basically we don't believe in exiting on performance, right? We believe in exiting on merit. So what tends to happen is if in a cycle, a particular asset is doing better, and the last few years you have seen equity really perform, then we're not going to exit unless the fundamentals of the business have changed and it requires an exit, right? So automatically your portfolio will be more skewed towards equity. For newer portfolios, the allocation to equity is significantly less. It's to start off with, you might be 30-35% in equities and more oriented towards fixed income and precious metals, right? So these are our key portfolio terms. So we are a SEBI registered PMS, which means that by SEBI regulations, the minimum investment is 50 lakhs. Our benchmark is the NSE Multi-Asset Index 1. There is no exit load, and we charge a flat fee of 1.5%. We think that this product is actually going to work best for somebody who comes with a 5 to 7 year horizon, because that would allow them to actually experience a whole cycle of multi-asset investing and get a flavor of how investing works. We have a very flexible mandate where we can go 0 to 100% in any asset or instrument in terms of stocks, mutual funds, and ETFs. And in terms of concentration risk, we don't want to take a single bet beyond 25% of the portfolio. So this is just our team. There are a lot of people behind making all of our portfolio management service products work. And let's just take a moment to see who all they are. Of course, Shyam sir is our CIO as well as the fund manager for all the products that we offer. And with that, I think we can open it up for questions, and I'd be happy to take in anything that is on your mind. If there were specific things about today's presentation that you would like to go over, or if you have questions about what we do at Sphere, I'll be happy to answer that as well. So you can quickly type in whatever you have in the chat box, and I can take it from there. I don't. So for the first question, heard from an RM saying that Sphere at the moment got limited investment opportunities due to cap on overseas equity. Recommend Solitaire is better. So one is, see, the overseas opportunities are not limited because we are contrarian in nature, right? The caps come in when there are a lot of flows into that, into a particular scheme or theme, and we are never chasing performance in overseas investment. So I don't think that is one an accurate representation of how we function. I also don't think that it makes sense to look at it that way. We do have exposure almost, I think today nearly 10 to 15% of the portfolio is in overseas investment. So I think that is something that, see, from a regulatory perspective, yes, there are going to be issues that come in, but I think from a mandate perspective, we have not had any problems in deploying or participating in global themes. Second, in terms of whether Solitaire or Sphere is better, we don't actually position it that way. It's about what would work best for you. And these products actually, so if we look at each of the mandates, right, they are very different. So you have Vriddhi, which is small and mid cap. You have True Blue, which is pure blue chip. You have Solitaire, which is multi cap. You have Sphere, which is multi asset, right? For a given investment objective or for a given risk profile, there are one or more of these products can actually work for you. So we don't really compare within in-house because fundamentally the core philosophy is the same. Everybody does value investing. Everybody looks at high quality investments. Everybody is contrarian in nature. And this is the same structure that goes into each of the portfolios, right? So the outcomes cannot really be good or bad. The outcomes are going to be the same quality. What can work is that one product may not work for you, another product might work better. We are quite positive on gold in terms of performance. We have been for a long time. You can see, like if you look at our content, the kind of webinars we had, even last year we had done webinars on gold mining. These are all themes that we have continuously talked about. We do believe in being a little bit more conservative in today's markets. In Sphere, we have a flexible mandate. It's kind of like Solitaire for the equity portion, meaning we look at across the board of large, small, and mid. Our primary focus is on high quality. I think now, if we look at overall how the markets are valued, we will see that large caps are trading at cheaper valuations compared to mid and small caps, right? So there is that bias, of course, in the market. How do you see gold from now on as it has moved fast? Do you see underperformance in the future? No, I don't. I think it's a little too early to see underperformance because if we look at global cues, right? Uh, like I mentioned, one of the factors in terms of gold prices is that if there is this reduction in interest rates, which has to happen because we've just been moving upwards. And we know that even interest rates work in cycles, so you have to come down at some point. There will be a shift from, say, fixed income into, like, say, your government securities into something which is going to be more store of value. And gold would be an obvious sort of option for that. And if you also look at, again, the trends in terms of how central banks have been buying gold, you will see that the level to which they've been increasing their gold reserves is indicative of that it's not the cyclical end. That's the way I would read the data. Of course, there are other interpretations as well. Yes. So if you're in the mutual fund space, you can consider multi-asset funds. You can also kind of create your own multi-asset portfolio by having different investments, right? So you can have equity mutual funds, you can have sovereign gold bonds, you can have fixed deposits, you can have all as mutual funds itself. So there are many ways to create your own asset allocation. And that is something that we do with people in the Milestones to Wealth program as well. So if you're a mutual fund investor, you want some hand holding, you want some asset allocation, you can definitely reach out to us. I'll just put our number here so that anybody who's interested can actually drop a quick message on WhatsApp to 9500027285. And I think that way we can also take the next steps and get you on board. The minimum investment is mandated by SEBI, sir, because we are a SEBI registered PMS. By PMS regulations from SEBI, they want to keep basically a certain threshold to protect retail investors from entering into equity markets directly without really understanding the risks involved. I think that's the intent behind the regulation because I think previously the minimum was 50 lakh, 25 lakhs, and then they increased it to 50 lakhs. What kind of investment is done in the global category? I think you have primarily today the easy access is through the mutual fund and the ETF route. Direct stocks are not that possible right now. There are some regulations coming into Gift City, which I think can enable that as well. But as of now, this is the route that we are using. So if see there are actually see the product universe on the global side is actually expanding, right? Like if I look at say 5, 10 years ago, in the market, you had a few funds. Like the only I think even on the mutual fund side, PPFAS was the one that was known the most to have some global stocks in the portfolio, right? Today, you're seeing more and more mutual funds take up these selective opportunities within their domestic portfolios itself. They have some mandate to buy some global stocks. So I don't think this is really going to be a problem. If it is a problem today, I only see it getting better in the future. I don't see it actually getting worse, right? Um, it doesn't mean that you have to invest more in domestic equity. It means that we have to be a little bit more creative in our asset choices, right? So, for example, let's say I am really constrained and I cannot buy any global ETFs or stocks, then I can look at a proxy play, right? I can look at a domestic company that does purely exports. That can be a proxy play. I can look at a different asset class altogether because why am I looking at global in the first place? Because I have a valuation concern with domestic, right? And by and large, I think if you look at the global context today also, India is in a very good growth space. right? Which means that from a valuation perspective, probably we are in a better wicket than global peers. So I don't actually see this as a issue that for us as a portfolio management service. I think during market volatility, there are few things. One is we should prepare in advance, right? We shouldn't respond to volatility as it is happening, because what tends to happen is we become very emotional in our response instead of being a little bit more goal focused. So you can prepare for volatility by creating some liquidity in your portfolio. So if you're able to book profits, move out of one asset class, start doing some groundwork on where you want to be next, talk to your advisor, talk to your distributor if you're working with mutual funds. If you're a PMS investor, then talk to your point of contact, ask them what you should be doing, and prepare to sort of participate as the volatility hits. If you're already in a volatile phase and you don't know what to do, the best thing to do is to review your portfolio, because then you can identify the key action items and say the market moves up one day, then you can start exiting ideas that you're supposed to exit. When the market moves down, because you know what you have to scale up, you'll be able to take those actions as well. So Sphere is a PMS, sir. The taxation happens on the security level. It doesn't matter whether we are 65% in equity or 10% in equity. It depends on the individual securities that we sell. So if I sell a stock, it will always be 10% for long term, 15% for short term. If I sell a debt instrument, it will always be slab rate for the investor. So we don't have, unlike multi-asset funds, we don't have this mandate that you need to be so much in equity or that you need to be so much in fixed income. We do have true flexibility, and that's what sort of sets us apart from the multi-asset funds that are available in the market. Okay, so next question. My intention is more to diversify risk rather than concentrating on pure equity through Solitaire. Your thoughts on this, please? I agree, concentration on equity asset class through Solitaire helps to achieve more returns when the opportunity comes, but drawdown, as you can show, be more when crash happens. Yes, that is true. But I think also the philosophy in all of our portfolios is that when the drawdown happens, the investor who participates actually benefits more. So one is, yes, if you do want to diversify, it's a good time to diversify. Especially in multi-asset today, I think all the cylinders are firing, right? We've had a really pretty much all your asset classes are going to be performers in this cycle. So it makes sense to have that allocation. However, if you want to stick to solitaire as an investment, I think one thing that you should be prepared for is keep some liquidity for that portfolio, right? Maintain something, because when the correction happens or when the drawdown happens, they will be very aggressive in terms of participating in that drawdown. And it would be a shame if you miss on that, because you've been such a long-term investor as well. Uh, so I hope that answers your question, sir. If there's anything else, I'll be happy to talk you through both Sphere and Solitaire. So I'll just move on to the next question. In Sphere, can an investor choose what percentage to allocate in a specific asset class? For example, if I opt in and don't want to invest in commodities, is it an option that I will have? See, this is a discretionary PMS, which basically means that the fund manager gets to decide where the investment happens, in what percentage, etc. If you have certain restrictions, probably at the time of account opening, you would need to create or declare all of those restrictions, and we can adhere to them per compliance rules. We are a PMS, then why do we invest through mutual funds? I think, see, there's a big misconception about mutual funds not being a good investment tool, right? I think they're a great investment tool, and I'll explain why it's there in the PMS. Now, for sure, what I'm not buying is I'm not going and buying a large cap fund or a mid cap fund. right? But there are certain times when I want to do a thematic investment. Let's say, so one of the themes that we had participated in was the public sector theme. Now, if I have to buy stocks of public sector companies in the portfolio, and let's say I keep an allocation weight of X%, then I might be restricted to only participating in 2 or 3 stocks, right? Because I can't take too much exposure, because if I diversify too much, then I'm not really going to get that benefit, right? But that same X%, if I'm able to buy a thematic mutual fund, like a public sector fund, right? Then I'm getting the exposure to the theme, I'm getting the diversity of participating in multiple companies, and I'm not actually reducing the quality of the portfolio. So there are specific mutual funds that work for Sphere. It's not a broad-based thing. It's not that we're going and buying some multi-asset fund, or we're not reducing the level of work. We're just trying to help investors participate in the right themes at the right time through the right instruments. For us, mutual funds are just an instrument. It's not necessarily something where we're trying to delegate the work to somebody else. It's a very strategic call. Okay, I am in milestone 4. My real estate is less, so what should I do? I think, see, there will be a time to buy real estate, and when that happens, you can participate. So you will have to make that asset allocation shift. But first, I think the objective is to really create that wealth, right? And you need to go through that journey. So there are still some more milestones left for you. Uh, the real estate decision is driven by 2 things. One is the opportunity, that is, if you find a house or a property that suits you, then it is the time to participate. But that is also determined a lot by your financial circumstances. But the second is really the cycle, right? So you want to be able to participate in that asset at the right point in the cycle, just like how you have fixed income, gold, equities, there will be cycles for real estate as well. So that's the key thing. As different asset classes are involved, will the churn cost and brokerages be higher in Sphere? No, actually, this is data that we've been working on. I don't have it available at the moment, but I did want to calculate the churn. See, this is something I mentioned earlier in the webinar, but I'll mention it again, which is that the reason why your equity allocation is large in terms of moving to 80% is basically because we don't exit because an asset has performed. We exit when we feel that fundamentally the business is no longer attractively valued, right? So just because I make a 15% return on an idea doesn't mean that I'm going to exit the idea because I've made my target return. I will actually evaluate at that point, at this price and this valuation, is it still a good investment to be participating in, right? So our churn is actually pretty low. And I think we have done maybe, okay, I don't have the numbers, but we've not done that many exits, even though we've been around for 2.5 years now. But this is data that definitely in the next webinar we will be putting out, and we can work on that. All right. So this will be my final question. What is the kind of correlation between the PMS products, meaning between Solitaire versus Sphere versus Vriddhi versus Trueblue? This will help to decide which one to start with and which one to add another 50 lakhs, so that there is some sort of negative correlation and risk immune. I understood your question, but actually I don't have this data. Maybe we can work on it internally and come back to you, sir, because I don't want to answer it without the data. What is the tax exposure for these investment schemes? So I think for the other PMSs, right, they're all pure equity, which means for any long-term investments, the tax you pay is 10%. For any short-term investment, the tax is 15%. In Sphere, I think your blended tax rate might come, and I'm talking about like a liquidation tax rate that might be closer to 15 or 20%, because you do have some asset classes that are at a higher tax rate. In PMS, but also like just to point out, like before you think that's a very high tax rate to pay, The basic thing is you're looking at a total liquidation, right? And that doesn't happen because we are a low churn investment. So in a given year, there may be only a couple of exits, if at all any, that will happen, which means that your blended tax rate is actually not going to be that high. It's only if you sell the entire portfolio, then you will pay that level of tax. All right. In PMS, do the investors have the option to increase the investment amount after investing the minimum 50? Also, is there any other fees apart from the fixed fees of 1.5%? Yes. So all of our PMS products are actually curated to allow investors to participate in them like they are saving investments, because that was the goal, right? We want people to use this as a saving solution, not as a one-time, I had some money, I put it in the market. Not that. That's not our intent at all. So you can continuously contribute. In fact, we have a lot of investors who do SIPs in Sphere. We have investors who are running their own businesses who give us money on a quarterly basis. So that kind of participation is pretty flexible. It's up to you how you want to participate. And you're more than welcome, because that's when you get the full benefit of being in this product. Uh, in terms of fees, there is no performance fee, but there will be certain expenses which will come at actuals. So, for example, it will be 1.5% plus tax. But if you have things like security transaction tax or the custodian fees, those are all charged at actuals. But it's not a large portion, and it won't meaningfully change your fee structure. Um, in the sense, like, it's not like a 10% profit sharing. It won't be at that level. It'll just be actual costs. Uh, yes. We will connect with you offline, sir, in terms of your question, because I think we do need to do some work before we come back to this. Uh, Yes, okay, I will take your feedback, and probably from next week we can show you performance of all of our schemes. We do publish this data every month. We have a fact sheet as well as a performance sheet. So I'll be happy to share. So if you can drop us a message on WhatsApp at 9500027285, then I would be happy to share the product deck so that you can actually compare the schemes and see the performance data. Um, Are you paying short-term and long-term profit taxes so that we need not worry about liquidity? I am not sure what you mean by that question, sir. We profit book only on merit. We don't profit book to create liquidity in the portfolio. If we feel that an idea is worth exiting that or reducing exposure to, that is when we book profits. We don't do it so that we can create more cash in the portfolio. That's not our philosophy. Okay, I think we've come close to the end of our Q&A. If there are more questions, I'll definitely be happy to take it. But I would first like to thank everyone for coming in today and for participating and making the conversation so interesting. We do have webinars running every week, so you will see my colleagues also have some sessions of their own. It's been a real pleasure talking to everybody today. If there is anything that you need, please feel free to reach out to us. We want to work with more investors like you, and this has been a great opportunity. So thank you, everyone. Thank you, sir. Your feedback is most welcome, both positive and uh, any criticism or anything that you might have. We'll be very happy to work on it. I have taken a few things away from today's session, so probably in the next webinar, you will see some more of that data and whatever you've asked coming in. Thanks a lot. The recording for our session will be available on YouTube, so you will be able to access it when required.